All participant lines will, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj Digwalekar from CDR India. Thank you, and over to you, sir.
Thank you, Nirav. Good morning, everyone, and thank you for joining us on Max Healthcare's Q1FY25 earnings conference call. We have with us Mr. Abhay Soy, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A, and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to all, and a warm welcome to Max Healthcare's earnings call for the first quarter of fiscal year 2025. It has been a very promising start to this financial year. I'm pleased to share that we have operationalized Max Super Speciality Hospital Dwarka on July 2nd. Located in the heart of South Delhi, it is a 303-bed hospital equipped with the latest high-end technology and currently has 125 doctors and 480 nurses, paramedics and support staff. The hospital is seeing good traction since the launch. Presently, the hospital teams are engaged on various fronts, including patient outreach, empanelment with insurance companies, clinical accreditations, etc. Yesterday, we announced a build-to-suit transaction for setting up a 250-bed hospital in Mohali. This 2.75 lakh square feet building with attendant parking will be constructed by the developer as per our requirement and specifications. This is a long-term lease extendable up to 50 years at our option, and we expect to commission the facility before in FY28. The hospital will cater to surrounding areas of Himachal Pradesh, Punjab and Haryana. This is in line with our asset-light strategy, which allows us to expand while insulating against development risks. Further, in strong demonstration of our turnaround capabilities, both Lucknow and Nagpur hospitals that we acquired at end Q4 last year are ramping up well. With an average occupancy hovering around 60%, for Q1, these hospitals contributed rupees 99 crores to the revenue and rupees 18 crores to the operating EBITDA, reflecting a year-on-year growth of 21% and 64% respectively. And more importantly, this was done within the first 3 months of us acquiring these facilities. Collectively, their ARPOB stood at 45,300, an annualized EBITDA per bed of about close to 30 lakhs. A large part of the post-merger integration activities has been completed now, the results of which will be more visible in the quarters to come and further augmented as new clinical teams join and infrastructure is upgraded there. Now coming to the Q1 performance, this is our 15th consecutive quarter of year-on-year growth. Overall, network gross revenue stood at 2,028 crores, registering a growth of 18% year-on-year and 7% quarter-on-quarter. Network operating EBITDA was rupees 499 crores, net of one-time charge of rupees 6 crores towards pre-launch costs at Max Dwarka. This reflects a growth of 14% year-on-year and a marginal decline of 1% quarter-on-quarter. Profit after tax stood at 295 crores compared to 291 crores in Q1 last year and rupees 311 crores in the previous quarter. While we expect substantial improvements during the course of this year, we are also infusing equity in the Lucknow subsidiary to bring down the finance costs. All numbers from here on are going to be now shared for a like-to-like basis, excluding new hospitals. One average occupancy for the network increased to 77% from 74% in Q1 last year and 75% in the trailing quarter, while occupied bed days grew by around 5% year-on-year and 2% quarter-on-quarter. Average revenue per occupied bed, ARPOB, for the quarter improved to rupees 80,100, growing by 7% year-on-year and 3% quarter-on-quarter. Year-on-year improvement in ARPOB was largely due to growth in oncology, orthopedics, and renal sciences, as well as increased number of robotic procedures. This was coupled with tariff revisions for self-pay, insurance, and institutional segments. Network gross revenue was rupees 1,929 crores compared to 1,719 crores in Q1 last year, and rupees 1,847 crores in the previous quarter. This reflects an increase of 12% year-on-year and 4% growth versus the trailing quarter. The international patient revenue stood at rupees 158 crores. There was a temporary impact on patient flows from some countries due to political situations and credit risk management related actions taken by us, which accounted for the muted growth in this segment. Network operating EBITDA stood at rupees 487 crores, reflecting a growth of 12% year-on-year while declining by 2% quarter-on-quarter. Operating EBITDA margin stood at 26.5% for the quarter. Growth in EBITDA was impacted due to annual merit increase, GST on variable management fee, and drop in footfalls for immigration health checks owing to change in visa regulations by some countries, particularly Canada and UK. Annualized EBITDA per bed stood at 74.7 lakhs, clocking a growth of 6% year-on-year. Profit after tax was rupees 316 crores versus 291 crores in Q1 last year and rupees 322 crores in the previous quarter. Free cash flow from operations was rupees 258 crores. Of this, 213 crores was deployed towards the ongoing capacity expansion projects and upgradation of facilities at new hospitals. Consequently, net cash position stood at 66 crores at the end of June 2024. Continuing our efforts to support the local communities, we treated approximately 36,800 patients in OPD and 1,150 patients in IPD from economically weaker sections of society entirely free of cost or free of charge. Both our strategic business units continue to report significant growth in their revenue and profitability. Max at Home reported a top line of rupees 49 crores, reflecting a strong growth of 23% year-on-year and 6% quarter-on-quarter. This SBU offers 14 service lines over 10 cities and continues to experience a very high rate of repeat transactions. Max Lab, the non-captive pathology vertical, now offers its services in nearly 50 cities and has a network of over 1,100 collection centers and active partners. This strategic business unit reported a gross revenue of rupees 41 crore, reflecting a strong growth of 21% year-on-year and 6% quarter-on-quarter. Now coming to the status of expansion projects. For the 590 beds at Lucknow Hospital, the work on refurbishing the existing facility is underway. Finishing work for operationalizing additional 140 beds has started. We have also received the environmental clearance approval for setting up a new 450-bed tower on this site, and we expect to complete the development of the new tower within 24 months. For 140 beds at Nagpur Hospital, work has been initiated to add around 25 beds through internal reconfiguration by Q3FY25, and environmental clearance application for adding 115 beds on 2 additional floors has been filed. We expect approval over the next 2-3 months and the project completion in the next 24 months as well. For 241 beds at Nanavati, Phase 1, the hospital structure will be up in this month and the project completion is expected by end of this fiscal year as communicated earlier. The project continues to be on schedule. 375 beds at Max Smart at Saket Complex. The project was fast-tracked in Q4 and we expect its completion by Q1FY26. This is a steel structure building and the installation of columns has already started. The site is fully mobilized and we don't expect any further delays. For 155 beds at Mohali, work on the second floor slab is underway while the work on ramp area is reaching ground level. All high side equipment has been ordered and the project is on schedule. We expected completion by Q1FY26. For 300 bed at Sector 56 Gurgaon, basement slabs are nearing completion and the project is progressing as per plan. Orders for all high lead items have been placed. We expect completion for the first phase by Q2FY26. For 250 beds at Patparganj, phase 1, post issuance of the no objection certificate by the fire and water departments, we have submitted the drawings for approval and the tendering process for this project is on. For 415 beds at Max Vikrant Saket, the environmental clearance and consent to establish has been received. The barricading and D-walls, etc. has started. We have applied for forest approval and are still awaiting the same. We expect some delay due to ongoing litigation involving DDA and Delhi government regarding cutting of trees in the eco-sensitive zone near Sola and the ridge areas without approval. With this, we open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. Participants, you may press star and one to ask a question. First question is from the line of Amey Chalke from JM Financial. Please go ahead.
Yeah, thank you for taking my question. The first question I have also is in Lucknow Sahara unit. I understand that we have a plan to expand unit to 550 beds, and then there is another tower which could come up. But what is the near-term action plan for the existing units of the 250-bedded unit in terms of the specialty addition, etc.? The ARPOB, I believe, are substantially low. So what would be the driver going ahead for this unit to improve the ARPOBs from?
So clinical programs is clearly one, adding doctors is the other, and that's how you sort of achieve clinical programs. Improvement in infrastructure. So we're expecting to refurbish the entire, the present infrastructure as well as add the 140 beds by end of this calendar year. I think as far as clinical programs are concerned, oncology represents less than 2% of the total revenue in Lucknow, so that's a major driver for us. You know, it is a high sort of ARPOB business as well as contributes more than 24-25% to our overall revenues. So if you look at sort of implying that over there, you'll see a major fillip in ARPOB. I think, like I mentioned, we've had in the first 3 months, literally, we got there, we acquired it end of March, and April, May, June, compared to April, May, June last year, there's been a 60-odd% increase in EBITDA, and this has largely come through all the sort of low-hanging fruit, etc., which is there. The real changes that we may have made, you're going to have all of those sort of pay dividends in the quarters to come. Also, typically we have a higher proportion of surgical business that we do in our hospitals and a lower proportion of medical business, whereas in both Nagpur as well as Lucknow, the situation is the other way around. It's a higher sort of, so when your surgical mix moves up with respect to the medical mix, you see higher ARPOBs in any case. So there are plenty of levers, so I'm not sort of concerned about that. And frankly, I think the kind of traction that we are getting, the kind of the early wins that we've been able to demonstrate over there, gives me a lot of confidence that we should be able to ramp up both ARPOB as well as profitability there.
So this oncology addition, etc., should we expect it in the current existing unit, or it will happen when the expansion for the bed addition happens?
No, the existing unit, they already have bunkers for radiation, etc., which are non-operational. We will just operationalize this. The 140 beds that we are adding as well as this thing that we are doing is going to happen by the end of the year. Actually, even the new tower that we are building is going to be done over the next 24 months because, it's 27 acres of land. We don't have to do so many basements and so on and so forth. And, similar to what we've done at Max Smart and some of the other things that we're looking at. But yes, the oncology business should ramp up in the current year itself. I mean, may not ramp up to 25%, but you'll see ramp ups in the quarters to come immediately, as well as the surgical business, right?
Sure.
I mean, even after we sort of take over these, when we start adding doctors, when we give doctors letter of intents and they sign up with us to join us, they have a 2-3 month notice period. So it takes them kind of time to join us. And as the infrastructure sort of the equipment has been ordered, the new equipment and so on and so forth. As that comes through, you see more and more teams coming up. Right now, all the technology, all the equipment is being replaced and so on and so forth. Right.
Sure. The second question I have is on the Dwarka unit, which has been recently commissioned. If you can provide some timeline over there, how the ramp-up will happen, and in terms of the specialty, is it at par at present with the other units, or you think the improvement will happen over a period of time? Thank you.
So in terms of the infrastructure is concerned, it is at par. I think the bunker is not ready as yet. That is going to be ready in due course. But other than that, I think as far as infrastructure and technology is concerned, not only is it at par, but it's the new generation. So I would say it's perhaps 1 or 2 steps ahead of the existing infrastructure. We have again seen very, very good traction over there. It is a massive facility. It's the best infrastructure of its kind in the region of Dwarka. There's a huge amount of again, fantastic traction is what we've seen in the first month itself, and I think this should continue. You should have a break even no more within 6 to 8 months.
Sure. Thank you. I will join that.
Thank you. Next question is from the line of Lindy Tan from Land Global Investors. Please go ahead. Lindy, sorry, we are not audible. I mean, you're not audible. Can you speak through the handset? Lindy Tan, can you hear us? Lindy Tan, your audio is not clear. Can I request you to speak through the handset?
I don't think he's talking to us. Why don't you take the next?
Sure. Next question is from the line of Rishi Modi from Marcellus Investment Managers. Please go ahead.
Yeah, hi, Abhay. Can you hear me?
Yes.
Yeah. So, Abhay, just on the Mohali hospital that you're planning to add 4 years out, right? Is this going to be firstly an O&M agreement the way we have with Devki Devi and those kind of hospitals? Or is it an outright rental sort of a model that we see in retail where we don't incur a capex, we have to just put in a security deposit and we start operating on it?
So it is the latter. We are leasing it. It's an outright rental stroke lease model where somebody else is putting the infrastructure and has invested in the land, making a build to suit. It's a 50-year lease agreement. The only difference is normally you have commercial leases for 9 or 15 years or whatever, but here there's pretty much a 50-year lock-in. So yeah, it's a 50-year lease agreement that we will have.
Okay. And so just from a broader conceptual point of view, right, are we seeing incremental interest from, say, the builder or real estate community towards having these sort of models? Or like if you can just share your observations from across North India or rest of the country?
You see, it depends on the tenant. Today, if you tell a builder that you please make a build to suit, and I will give you 8.5% yield, and I'll give you 3-4% increment every year. I mean, that is what the market is, right? As far as commercial real estate is concerned. So as far as the builders are concerned, developers are concerned, they're happy to do it for commercial real estate, for retail real estate, or for hospitals. The question is how many hospital chains can offer this. Your own ROCs have to be significantly higher than what you're paying out over there. So I think, in our situation, we are able to take up these hospitals because our ROCs are significantly higher. And so this build to suit kind of model works for us. May not be the case. I mean, it certainly works for the developers. They are taking a punt on our balance sheet effectively, and that is where they're getting this thing that look, we'll be around for 50 years, and they'll be able to, after even making that particular hospital or this thing and dedicating it to us for 50 years. Because do remember, this is built to suit, so it's as per our design. So if somebody is building something for, under certain specs and is leasing it out to you for 50 years, he has to sort of be very confident that you will be around for 50 years and your balance sheet will be able to hold it. But I think that's a punt a developer needs to take because eventually you're tenants. But here you're tenant for 50 years. It's not as if you can move this hospital and you start using it for a mall or give it for some other purpose or hotel or whatever else it is.
Right. All right. Second, just I think you went through the capacity addition plans and updates pretty quickly, but just on an overall basis versus Q4, any delays or any preponement, just if you could highlight that piece?
Not really any delays or preponements. I think you're going to have, except for Vikrant, I think, which is the last one, which in any case was a 2028 generation hospital, which we're expecting maybe a couple of quarters of delay on that one. Other than that, we're not expecting any delays. So you should have Mumbai, Mohali, as well as Saket up by Q4, Q1.
Okay, got it. Yogesh, I had a question for you on the tax rate piece. So I'm seeing our tax rate for this quarter has come up to 26%. Just wanted to understand, because I'm under the impression that we have a tax benefit in the BLK and the Nanavati and now with the Dwarka unit. So is my understanding correct, and this is just a factor of the profitability for these two charitable hospitals? If you could just help me understand the tax piece for y'all.
That's right. So this is Yogesh. Yeah, so overall rate is 22.8%, right? This quarter the rate has gone up because we have losses in the new entries, mainly the Sahara Hospital entity. This Sahara Hospital transition was 993 crores. We funded this by 840 crores of loan into the entity. And as I mentioned that, alluded in his speech, that we are changing the capital structure in the company. So since we have losses in the company, we don't, do the DTA as per our policy till such time the company is profitable, right? So that means you have these losses, but you have the tax off on the other entity. So that's the reason why the rate has gone up. But otherwise, the rate was same as in quarter four. Quarter four was 21.8, and we do think that, going forward, we will be around 22% rate.
Okay, but so just if I take a calculation, right?
Also on the BLK, the whole, the agreement is that whatever is the net profit, 98% of the profit comes to us, right? So the moment we withdraw that money from there, there are two taxes on that. One is there is GST, and also other is that when the money comes on this side, then we have to pay tax on it, right? So to that extent, BLK doesn't allow me any tax shield. We don't trap money in trust. We sort of take it, we pay full tax on it.
Okay, so for example, now BLK, there is no capacity expansion plan, so you're taking the money, repatriating it to the holding company. But Nanavati, we have a plan of expansion, hence we are not repatriating. But once that expansion is done, it will also become like BLK. Is my understanding correct?
That's right. But also this formula is on cumulative basis, right? So what happened is that the BLK wiped out their losses on a cumulative basis last year, quarter 2. So the withdrawal has happened from quarter 3 onwards, right? So similar thing will happen for Nanavati in that entity.
Down the line, it will start paying off.
Yes.
All right. Okay, understood. Yeah, that's it from my end. Thank you.
Thank you. Next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, thank you for the opportunity. My first question is on the margin contraction which we have seen in first quarter. Can we attribute most of that for the new facility cost, or between 4Q and June quarter, have you seen like any major change in the business mix say in terms of medical and surgical volumes which are coming to your facilities?
We've clearly seen a change in the clinical mix. It's moved to a higher end clinical mix. And like I've mentioned in the past, when you do higher end surgeries, you do more robotics and more oncology and so on. They typically have lower margins in percentage terms, but higher margins in value terms. Whilst you see a flattening of EBITDA margins, you see an increase in EBITDA per bed on the existing hospitals as well. So I think the takeaway should be that what is the increase in EBITDA per bed? We've got number of days in a year, and it's really 50%. You'd rather do a 20% margin on a 10 lakh rupee surgery than do a 50% margin on a 2 lakh rupee surgery, right? So I think its percentage is irrelevant. I think we should look at sort of. The other thing is that you had a reduction in OPDs, like I mentioned, in the current year, and these OPDs were largely from the immigration because of disruption in visas from Canada and from UK and a little bit in Australia. We've had reduction in OPDs, and this is the immigration income that we had. So that has had a couple of percentage point impact.
Okay. That's clear. And my second question is, couple of your hospitals are scheduled to start in another, say, 6 to 12 months, if I may say. Nanavati, Smart. Yeah. So just want to understand, when you are about to start a new facility, when do you start your pre-launch activities, and what kind of cost you are anticipating for these upcoming units?
So look, unlike Dwarka, which is it's a new facility. So what you have to do is you have to actually have a minimum amount of doctors and staff, etc., which is pretty much you need to staff the entire hospital. Okay, in that case, before you apply for even a nursing home license, right? So you're sitting fully staffed. Okay, then you make the application for the nursing home license, okay, and then so on and so forth. Getting all the really starting ground zero. All of the facilities that you sort of alluded to right now, be it Nanavati, Mohali, as well as the Max Saket, they're all existing facilities. So I don't need to promote the existing facility. There are enough people waiting in my ER over there waiting for beds, right? And it's going to be very similar to what happened in Shalimar Bagh. In Shalimar Bagh, we didn't have to have any pre-op expenses really, or promote those facilities, or even wait to get these. So all the contracts, everything is already pretty much signed up. So you won't see any pressure on margins over there. I think almost day one you sort of good to go. Okay,
understood. And my last question is on clarity on your Mohali planned hospital. So you said it's a 50-year long lease, and it's a build-to-suit premise which you will be getting. So there will be no capex once you get the facility leased. It's just say equipment and then people's cost which will be going towards this unit.
That's right. So we will be providing the medical equipment, and other than the deposit again, which is interest bearing, and loose furniture. The entire project cost is incurred, including the land and building, etc. More importantly, any delays, any cost time overruns, everything are to their account.
Mm-hmm. Okay, understood. Thank you.
I mean, this is very similar to what we've done in Dwarka, right?
Okay, so the way like Dwarka, it's an O&M facility which you got into your network, but
this is not an O&M, this is a lease, but the same thing as Dwarka in the sense that developer develops it and he incurs the project cost. We bring in the equipment and so on. Okay, and I mean, whether you look at O&M or a lease, the commercials are pretty much the same. Asset light.
Okay. Thank you. Thank you for your answers.
Thank you. Next question is from the line of Kunal Randeria from Axis Capital. Please go ahead.
Hi, good morning. In the last few quarters, the number of your institutional beds is stagnant at around 29%. Do you see headroom for some improvement over here?
We do see headroom for improvement here, but first quarter and usually the third quarters are weaker quarters. So compared to a fourth quarter, what you take your foot off the accelerator. That's not the time sort of this thing, because your occupancy levels subdue at that point of time. So if you want to kind of listen, then you're not going to churn your patients. Typically, you'll see churn happening in the second quarter and the fourth quarter.
Right. Okay. Sure. Because even I think in last quarter it was somewhere around 29%, right? So, I thought it's just in the last 5 or 6 quarters, somewhere in this range.
That's a Q4, right? The fourth quarter is a strong quarter. So if you see Q3 versus Q4, there may have been some change. But if you look at Q4 versus Q1, you won't have a change. So typically now again from Q1 to Q2, you'll see a change. But Q2 to Q3, you won't see a change.
I would also say there's a change that you don't see. That change is in the ARPOB of the business, right? So we do the PSU business, but while you may see the same beds, but the throughput of those beds has gone up. If I see the improvement in the ARPOB, it's Y on Y, it's a 10% improvement in the ARPOB of the PSU. So which means that we are within that beds, we are trying to do high-end work, right?
Yeah, sure, got it. The second question is on.
Distillation,
Yeah, sure. Second question on ARPOB. This quarter saw around 7% growth on your existing units. So is this the new normal that we should expect going forward?
No, I think we've had because of the immigration and visas. Okay, that's had maybe a couple of or 2-3 percentage point impact on ARPOB. That is something we had last year, but this year there's been some disruption because of Canada is not issuing visas. UK immigration visas have been sort of this thing, and you've seen the same with Australia as well. We believe it's a temporary phenomenon, and that business is sort of this thing. But if it doesn't, then we kind of repurpose that space to put more dialysis beds and so on and so forth. We'll catch that up, but so I think 7 would be a little muted compared to perhaps what we had in the past.
Sure, got it. And sorry, when you say this, I'm assuming or also mean the new units that are coming in, or it's only for the existing units?
Sorry, which is?
So when you mentioned that your growth should be higher than 7%, so does it include all the beds or just the new unit, just the existing units?
New units will be a significantly higher ARPOB growth, right? I mean, new units are starting at a low base. So if you combine the two, then your growth should be more.
Okay. For example, I mean.
Yeah. I mean, you had a revenue growth of 21% in the new units, right?
Okay. Because so you are saying that maybe Lucknow and Nagpur, whose ARPOBs are lower, should grow at a much faster pace than your existing hospitals.
And Dwarka.
Okay, sure.
Right. So I mean, your percentage growth, the absolute base is lower. They are starting on a lower ARPOB.
Sure. So okay. So
had a 21% and 64% growth in Lucknow and Nagpur on sort of revenue and EBITDA alone. So you can imagine huge amount of growth come from that, right?
Sure. And this one, I think Lucknow seems to be like a go-to spot for a lot of your peers also. Do you think that so many beds coming up in that area, there is enough medical talent available, both from a doctor as well as from a nursing perspective?
Actually, I don't know of any other hospital coming up there. And besides Medanta, which has been there for a while, and Apollo, a smaller Apollo facility, which has again been there for 5-6 years. And this was also existing facility. And other than that, we've only bought the land, on Shahid Path, which is opposite Medanta. But I haven't heard of any other hospital really coming up there.
But nevertheless, we see an abundant supply of talent there. In fact, the doctors that we employ in Delhi, and a lot of them are from SGPGI, Lucknow. So to that extent, we haven't really.
So, historically, Lucknow has been the place where we've got most doctors. 25-30% of our Delhi doctors are from Lucknow. So historically, Lucknow has had medical colleges and government medical hospitals, etc. And it's a big sort of base of doctors there.
Right. Okay, got it. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Dinesh from Vital Capital Management. Please go ahead.
Yeah, thank you for the opportunity. Sir, which quarter do we take the annual increments? Is it this quarter or?
1st of April.
1st of April, okay. For the Mohali asset that we mentioned, it would be possible for you to share how much the real estate partner is investing in land and building for the 250 bed?
I can't share that. He already, he owns the land, so he would have.
So we have a fixed rental
specifications and our BOQs. Then they don't sort of share what they're spending. But usually, land and building will cost. But the building alone will cost about 80% of the total project cost if we were to do it.
The line for the participant drop. We move on to the next participant. Next question is from line of Adrit Chaturvedi from Nomura. Please go ahead.
Hello. Hi. So I have a question specifically regarding the inpatient business. So you reported this quarter around 1,600 crores of...
Sorry to interrupt. Your voice is coming muffled. Can you speak through the handset, please?
Hello? Am I audible now?
Yes, go ahead.
Yeah. So my question is specifically regarding the inpatient business. So you've reported around 1,600 crores of IP revenue. So that's around 21% YOY growth. And also the volumes have grown by roughly 17%. So that translates to about like 3.5% growth in realization. Now this 3.5% is sort of one of the lowest in the preceding quarters. But at the same time, the volumes are like highest in the preceding quarters. So is this the sort of business profiling that we should come to expect as you grow and you expand, that your realization per patient on the IP business is going to be around 3-4%, but you're going to focus more on volumes?
No, I think you are looking at the overall number, which includes the new facilities, right? So you should compare the number on Y basis for the existing hospitals separately, because the new hospitals, ARPOB is obviously lower, right? And also, so to that extent, you find a volume increase, but not, the increase in the revenues because of the ARPOB issue, right? As I mentioned that, as we change the mix of the business in those new hospitals. We also put in oncology there and have more talent there. Slowly the ARPOB will inch up, right? So there's a difference of 80,000 to 45,000. The new hospitals have an ARPOB of 45,000, and our existing hospitals are having an ARPOB of 80,000, right? So we think that 45 will, surely come up fast. So it should be, anything between 65,000, let's say in a year's time. And that's how this will catch up, right? Then you'll find that the number increase and the overall revenue increase will kind of, start to have lesser differences.
Okay, so the backdrop also on the levers for these realizations, right? So like if you look at the sum of shares of oncology, cardiac sciences, orthopedics, neuroscience, and renal, like the share has come down this quarter on a YOY basis, and that's a first in a while. And even the...
It's because you are including the new hospital. Because you included the new hospital which have less than 2% oncology share, right?
So it will, right?
So what's the...
Because the new hospital share is very different from what we have in the existing hospitals.
Right. So when do you suspect, like, as the expansion ramps up, that we would have a sort of a resting rate where, as you said, ARPOB grows at roughly 9-10%. So I guess the realizations grow at 8%.
No. It doesn't work like that. See, please understand. Okay, what is it that we focus on? We focus on acquiring facilities. Okay, turning them around, see that this thing get higher ROCs over a period of time. But you look at it on an incremental basis, right? Now, okay. If we bought something, okay, with a lower EBITDA, lower ARPOB, okay, and we are demonstrating an increase in that ARPOB, it may or may not get to, a Nagpur hospital will not have the same ARPOB, okay, eventually that a Delhi hospital does.
Okay,
nor may it have the same EBITDA per bed. What you have to see is, okay, vis-a-vis what you paid for it, okay, what is the sort of return you're going to get, and so on and so forth. Yes, the levers for doing all of that, and what we are seeing is that levers for doing all of that is going to be better clinical mix, doing more surgical work, less sort of this thing, etc., higher oncology business, and so on and so forth.
Okay,
now, you may get to that mix of 25% or 24% oncology, okay, but you may not get to the ARPOB because, the rates over there are cheaper. I'm not even chasing the Delhi ARPOB with it, right?
Yeah, no, I understand. So just lastly, so a lot of your peers have mentioned that they're sort of translating a lot of the lower ALOS businesses to like daycare, and right now your IP business is roughly 80% of overall. So you don't give any separate numbers there. So do you have like any kind of qualitative color regarding what's the OPD margin profiling as versus daycare, and how it helps your margins if you sort of translate a lot of those lower ALOS to daycare and census beds, non-census beds?
Also, look, I think if you the lower ALOS business to this thing has its own sort of tenets with it, okay? Because currently insurance companies don't cover businesses where you don't spend the night in the hospital. Right? So you need to spend the night for insurance companies. Daycare business may not be covered by the insurance companies. That itself is a kind of this thing. So, by squeezing a lower ALOS business and doing a daycare, I mean, of course, if you can, a daycare procedure, okay, the longer you stay in a hospital, the hospital loses money, right? I mean, the surgical part is what makes money. So if you can translate anything into a daycare, get a person in the morning, do the procedure and have him out by the evening, okay, your yield is significantly higher. The question is, why is it that you can't do it? Because for a lot of the procedures, or for most of the procedures, you need to stay the night in the hospital to claim insurance.
Okay, so on the cash patients, is there a targeted strategy there to like move a lot of these lower ALOS to daycare? Or is it something that's not the focus right now in terms of your non-IP business?
So we do that as hygiene, right?
Okay.
I don't know exactly what you're seeking. So if you're able to articulate a little better, then perhaps I can answer you for this question.
I think for us, the ARPOB is the one that we go for, right? We will obviously, and this daycare procedure will be all run-of-the-mill procedures, right? Our focus is to go up the value chain, right? So we'll be pursuing liver transplant, oncologies, neuro, cardiology, cardiac surgeries. I think those are the procedures that we pursue, right? So while there'll be shift of some daycare procedure, one day stay, and you do it in daycare. Yes, we do. But I'm saying that's not the focus of the hospital administration to really go after, right?
And really depends what your proportion is, right? I mean, everybody's ALOS is sort of different because their clinical programs are different. Now, if you do a liver transplant, okay, your EBITDA per bed per day, your ARPOB is higher, your EBITDA per bed is higher, right? But the fact of the matter is the patient stays much longer. Now, would I replace that with the dengue patient, which has maybe a lower ALOS, but higher percentage margins, but lower sort of EBITDA per bed? No.
Okay. Thanks a lot. Thank you.
Thank you. Next question is from the line of Prashant Nair from Ambit Capital. Please go ahead.
Good morning. Just one question on your so as your new projects now start coming on stream over the next few years. So if you take some of your larger brownfield projects like say in Saket or Nanavati, when the new beds come online, would they have similar case mix, payer mix, ARPOB, etc. as the older beds, or would they start at slightly different levels and then match up to how the existing hospital beds are?
So you're going to have a different sort of mix to start with because, first and foremost, what you do is you try to ramp up occupancy over there in the new beds. And, when you do that, then you're not kind of very strict on the payer mix as well as the clinical mix. Okay, you are going to take, people who may not be getting priority today because that's a lower end payer mix or a lower end clinical mix, right? You kind of open your doors to it. So your ARPOB from the incremental beds is lower. Having said that, the EBITDA per bed is higher. So your profitability, because you get huge amount of operating leverage over there as well, right? Because your main costs and etc. associated costs, everything is already being incurred by existing hospital.
Sure. And second question, in these projects, so would the investment in the beds follow a similar pattern? So say a new greenfield project, you front load everything, right? So in brownfield beds, is there a period maybe after the first year, second year when you have to step up either investment in people or equipment, given that these beds are now ramped up, or are they all done at the beginning?
It's all done in the beginning. So you don't have to step up anything. I think brownfields, I understand you're pretty much, you're operating with the same set of people, the same majority of the equipment is already there. So yeah.
So the line for the participant dropped. We move to the next participant. Next question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity, sir. So just on this international patient ARPOB, if you could just help us understand like how much drop the ARPOB, decline in the ARPOB that has happened because of these issues related to visas, maybe year-over-year or a quarter-over-quarter both.
So international business has got nothing to do with immigration business. These are two separate streams altogether. The immigration business is where people come for visas, they have to get themselves tested and so on and so forth in our immigration departments, right? The international business is the incoming business that you have. I mean, immigration business is the people who have to, if you have to relocate to Canada, then you have to get your medical sort of tests and all done.
That's
right?
OP business.
It's OP business. The international medical tourism is people who are coming to India. It is two separate business streams.
Understood. So as far as international business, just to understand what kind of ARPOB growth we've seen over the last 2-3 quarters.
No, so Tushar, typically the ARPOB in the international business is 1.5 times of the overall ARPOB, right? In growth. So international business growth on ARPOB would be 7 to 10%, right? If you see the last year. So and also it changes, right? Quarter to quarter depends on what the profile of the patient is that you're getting. But that would be so it'll be overall growth because these tariffs are linked to the self-pay tariff.
So largely similar to that of the domestic patient in terms of growth, not in terms of value, but in terms of growth, we are largely similar in both international as well as domestic patient. Is that the right way to understand?
Exchange, yeah. So the pricing change is
pricing is linked to the self-pay, right? So we charge a premium on that, but then it's linked to self-pay.
Understood. How much would be the OPEX at Dwarka? Like as a operation cost when we say break even within 6 to 8 months. So if you could share how much OPEX is, and how much of that is already into the PM. Given that you said that we need to get the licenses and also you need to have doctors and nurses already on board. So does it mean that the OPEX is already in 1Q?
No, so Tushar, basically in this quarter we have 6 stores of pre-launch costs. These are the costs of the doctors and the staff that we had hired. Before you get the nursing home license, you're supposed to have people on your rolls, right? So you have to demonstrate to the department, to the Delhi Health Department, to say that we have so many people available for treating patients. So that is that cost. We haven't had any revenue from the hospital in quarter 1. Right? These costs will obviously get built, right? This is a cost which is for the quarter, but obviously if you take June month, the cost will be higher than the average, right? 6 stores is not for the full quarter. Not for the so if I take, let's say, June, if I take July, you will have further increase in the cost because we're adding more people. So we opened 94 beds at this point of time. And now I can't give you a P&L statement in terms of what the cost would be, but we do think that by 8 to 9 months we should be on a break-even state, which means that it should be in the quarter 4 that we start to see break-even numbers at EBITDA level for Dwarka Hospital.
So primarily just trying to understand in that time how much drag will be there on the existing EBITDA of say 500 crores. So from that perspective, just to understand.
So Shah, we said quarter 4 will break even, right? So that means the drag will happen till quarter 4. So in quarter 4, you'll see that loss becoming kind of break even for Dwarka.
Sure. Sir. And how much further investment would be required in Lucknow for this 450 beds once the EC approval is there?
So I think this will be around 700 crore plus. 450 beds investment. Yeah.
Got it, sir. Thanks. That's it from my side. Thank you.
Thank you. Next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Yeah, hi sir. Am I audible?
I am. Yes.
Yeah, hi, sir. Hi, team. So my question is, like I'm just reading the slide number 10, and I'm trying to refer the outpatient growth what we have seen, the fourth chart, where it shows that 4.5% has been the growth for the like-to-like or the existing hospitals. Whereas when I compare it for the Q1 FY24, a year back, this run rate was like almost 13-14% growth rate. How do I read this particular thing? 14% versus 4.5% right now.
No, so the OP results have come down. I can alluded that to in his speech also, that we had immigration business which is down by around 48%. Right, there's a large immigration, so we have 3 centers for immigration, right, 2 in Punjab and 1 in Delhi. Now the footfalls have come down by 48% there, right? So obviously that has impact in these numbers because that's all OPD business. So we do think that this impact will go until Q3, and from because Q4 was a normal quarter because we have this change in the visa regulation from 1st of January this year. So there will be some impact of that you will have.
But the good part is this is not the OPD business which leads to admissions or IPT, right? I mean, this is always immigration business. OPD people come to the consult, the same go out, so they don't get translated. Normally, reduction in OPD business or outpatient footfalls, would be concerning, because what that means is that you're going to have lower inpatients going forward. But this is not the category of people which converts to inpatients.
Shalimar Bagh, which is about 3% across, 3% with Shalimar Bagh domestic.
Also last year, I think we opened Shalimar Bagh, and so 3% of that was because of the capacity expansion, like Isha pointed out. That was last year. So it was new capacity which opened in this month last year, in that quarter.
So, like the kind of capacities what we are going to see in next 1 odd year, what is the metrics or what number you would like to see? Because for a kind of a run rate in terms of volume, what we want to see, and partly driven by ARPA, but partly driven by volume, this number should be high single digit. That's what could be a number for maybe a steady state growth.
Are you talking about the existing hospitals or new hospitals or combined?
Existing, sir, because combined it may not be a correct reference, but like when I just see that inpatient and outpatient both, and you say that partly would be the international, but then I am just like little confused that international patient coming off may not have so much impact.
So the material part is the inpatient.
Yeah, so inpatient is 5.5. That's what the second part of the question is, then what is the run rate I need to see in this particular number to maintain our steady state growth rate objective as a tracking point?
So I'll just give you an example of what happened in Shalimar, right? This is a hospital where we added 43% bed capacity. And the moment you have the capacity available, the capacity got filled up, the IPD volume and the occupancies went up by 34-35%. The OPDs and the IPD footfalls went up by 34-35%, right? So that's the same thing we expect here. To the extent that if there's a brownfield expansion and we are adding, let's say in a 300-bedded hospital, we are adding 150 beds. We plan to open all those 150 beds in one go, and to that extent, we will find that the volume will expand. Within 2-3 quarters, we should be on a normal occupancy.
But if you want to do apples to apples, like you added Shalimar Bagh capacity last year same time, this year you'll add Lucknow and Nagpur, and then see what the overall growth is. That's why I asked you the specific question, because if you're not doing apples to apples, right? If you're looking at existing hospitals last year, then you have to look existing hospital sans without the Shalimar Bagh expansion.
But sir, this is a volume count, right? So it is irrespective of what hospitals I am trying to count, because even I give that benefit of Shalimar also now part where I'm like in the existing part, and if it is 5.5.
No, I mean, I just look at it differently, right? So let's say last year, so you had 3,400 beds, and then you add, let's say, 200 beds to it, because you've done a brownfield. Now you move to 3,600 beds, right? You're not comparing the 3,400 to the existing beds today. You're comparing the 3,600 to the existing today. But you had that jump of 200 beds last year. Likewise, if you take a jump of 900 beds this year, okay, then you need to look at overall footfall.
So, let me just turn it the other way around. Just explain this. So basically, we have the highest occupancy among our peer group, right? Which means that we don't have more IPD patients, right? So what comes first? You have to have capacity to have more IPD patients. So that means to that extent we are limited by the number of beds that we have. And the example that I gave to you for Shalimar was that the moment we added beds, the volume went up. Okay. So as the capacity will get added, we do think this volume will materially change. We do think the volume will materially change because we don't have beds, right? How can I?
Okay. If we don't come up with brownfields, we don't come up with capacity addition, we're already operating at 77% occupancy. I don't have room for my bed occupancy to go up. Okay. Marginally only, right?
Yeah, this explains that particular thing, because maybe on the flip side, I was maybe trying to say, is there a shortfall in terms of whatever the demand expectation?
No. I mean, there's a shortfall of supply.
Okay.
There's a supply shortfall, and that's why we are doing all these brownfields, right?
Okay.
And that's where the Shalimar example fitted, right?
Right. And you mentioned that inpatient and outpatient doesn't have a high correlation with that particular thing.
No. It has a very high correlation. Okay. But the outpatient business which is reduced is the visa immigration business.
Okay.
If you're going to Canada, you used to come to get your blood test done, so you get your certificate from this thing that you're medically fit, right? So let's say if you immigrate to Canada, you would come to a hospital and get that thing because we were accredited with the Canadian embassy. Now that person was not going into an inpatient. He was not getting admitted for a procedure.
Right.
So the visa policy, right now Canadian government is not giving visas, so people are not coming for that medical certificate.
So if you would have added that missing part, it would have, what run rate this number 4.5 would have been? It would be in the
nothing. It will be the same. Inpatient would be the same.
Not inpatient, outpatient then, sir. That 4.5 would have jumped up.
Yeah, then that would have gone up. Yeah.
Okay. Fair enough, sir. I won't take much time. I'll drop off, sir. Thank you.
Thank you. Next question is from the line of Sumit Gupta from Centrum Broking. Please go ahead.
Hey, hi. Am I audible?
Yeah.
Yeah, hi. Thank you for the opportunity. So just want to understand on the bed share mix. So basically,